Okay, everybody, it is 1 o'clock Eastern. I'm just going to give folks another minute or two to join the webinar, and then we'll get started momentarily. Okay, we can go ahead and get started. Welcome everybody to Recession-Proofing Your Marketing Agency. My name is Chris Hervochon. I am a CPA and been working with marketing agencies since about 2015, first starting as an outsourced controller, now in the virtual CFO space. Goals for today. I'm going to throw a lot of information at you, so we're going to go fairly quick. There is a Q&A function in the webinar, so if you have some questions, by all means, go ahead and put those in there, and we will get to those at the end. But we're basically just going to go through some high-level, broad economic data, and then we're going to talk about the data as it applies to marketing and creative agencies. We'll talk about what we're seeing with our agency clients specifically, and then we will go ahead and talk about what to do next, and then provide some links to some helpful resources as well. This is the obligatory disclaimer as required by our insurance company. Basically what this says is that this webinar is for information purposes only. It is not actual advice. Your circumstances may be different than some of the circumstances that we describe in this webinar. And just by attending this webinar, you are not a client, basically is what this says. So our team, as I mentioned, I've been working with agencies since 2015. I've been full-time with our CPA firm here since 2018. Basically started as a side hustle way back when, been doing it for over a decade. And now we've grown to a team of 8. This is the team here. We are an international team, so we are all over the place, and we're also all across the US. And we are enjoying our time working with marketing and creative agencies for sure. So jumping right into it, economic data. First thing I wanted to show, this is a chart from Fred. Fred is the St. Louis Federal Reserve's basically data tool. It's open to the public, it's free to use. And what this shows is a long time horizon view of quarter over quarter GDP growth for the United States. So we're going back to maybe late 40s here, all the way up to the present day. The recessionary periods that we see over this time horizon are highlighted there with those kind of beige-ish bars. And, basically what this tells us is that quarter over quarter economic growth has been fairly steady throughout the course of, as long as this has been tracked, between 0 and 2.5% quarter over quarter. More volatile in the earlier years. It's been, certainly since I've been alive, since the early 80s, it's been much less volatile and much more steady. We do have, periods of fairly steep recessions, I would say. Certainly the 2008-2009 period was the most recent example of that. 2020 as well, but 2020 was a little bit more shorter lived. Certainly very, very deep though. We had another recession back in the early 90s, if you all recall that, and then a slightly deeper one in the early 80s as well. So if we look at the far right side of this graph, basically what we see is what economic growth is doing over the last 2 quarters. And there we go. If we skip to the next chart, this is showing the more recent history. So Those far right two bars, what we see is negative 1.6%, and then negative 0.6%. So those are the first 2 quarters of the year. Now, the question is, are we in a recession? I don't know. It depends. The question I would ask back is, do we really need to label it? So going through college and MBA program, I took plenty of economics courses. I read plenty of economics books. Generally, the definition of a recession is 2 quarters in a row of negative economic growth. Okay, that's fine. What I would say is, what is more important is, how is the economy impacting you and your business? What are you feeling? What are you seeing inside of your business? So yes, economic growth has been negative. Whether or not we're in a recession, I would say it doesn't necessarily matter. What really matters is the reality of what you're seeing as far as the economy and how it's impacting you. So at this point, I would, by classical definition, I would say we're in a slight recession, certainly not as bad as what we see in the early part of 2020, when we were having the lockdowns and when COVID was first starting to become a thing. So we saw a very steep recession there, very brief, but very steep, and then a very, very steep and very, very quick recovery. So will this time be different? Don't know, hard to say, but I'm going to throw a whole bunch of data at you in the next couple of minutes, and then you can decide for yourself. Now, GDP growth has been one of the major talking points in the news lately, and certainly it's the most common data point that we look at when we're talking about what the economy is really doing. Inflation is the other one. And this chart here is courtesy of Metis Wealth Management. Those are friends of ours, and they run probably the best financial advisory firm that I've ever come across, for sure. And this chart comes straight out of their quarterly newsletter that came out, I think it was last week, but it's recent. And this is as good of a chart as I've seen that describes the inflationary situation that we see right now. So what are we looking at? If we look at that consistent, I want to say it's bluish, purplish bar at the bottom, the Fed's inflationary target is 2%. That's their long run inflationary target. The top line, which I'm going to say is blue, I'm colorblind, so bear with me, is the headline CPI. So that's, or CPI. So that's basically everything. That's a fully baked inflationary number. That's currently at 8.26%. It's down from a high of, I want to say it was about 9.25, somewhere in that neighborhood. So we're starting to see that headline number contract. Now, the core CPI, which is basically your headline CPI, but you're going to strip out the more volatile components of that, which is food and energy. When you strip that out, that is starting to accelerate, and that is at 6.32%. So that gap that we see there is starting to close, and that's really what the concern is among economists, and certainly amongst our financial advisory friends. That's what they outlined in their Q3 newsletter. So that's the inflationary picture. I think that's a really good view of it. Now, more economic data, and we're going to get into some surveys here. Certainly the surveys that we pay attention to. This is the AICPA Economic Outlook Survey. The reason why we look at this survey, number one, we're slightly biased because I'm a CPA and we're accountants in our firm for the most part. So we are slightly biased, but the AICPA does this survey on a quarterly basis. And the reason why I think this is interesting is because CPAs are finance people inside of organizations, meaning they're working in internal private and public company finance departments, but then also CPAs are in public practice as well. And what that means is that CPAs broadly work with a large swath of small business in the US. And so they get this kind of, and certainly we get this in the firm as well, you get this picture of how small business is really doing. So that's why this is interesting. Now, the purple line on the bottom, that is the anticipated, or that's the optimism for expansion for the US. And you can see that if we were to extend this chart all the way back, I've been looking at this data for a few more years than what's on this chart because it goes back that far. But this, I believe, is at a historic low. So optimism for the US economy broadly amongst CPAs. As you can see, it's fallen off a cliff since 2Q of 2021. Now, what's interesting is if you look at, we'll call it that yellowish line, that's for the organizations in which those CPAs are in. So that is not nearly as dire as what they're saying for the US in total. And then if you look at that light blue bar, that is the expansion that is expected. All three are in downward trends. Certainly the most interesting line here to me is that US number. That is a much broader number. Continuing on, this is the expected growth of revenue and profits. Basically, what this is telling us is that profit is expected to be flat over the next 12 months. So this is forward looking. And we have seen that continue to trend downward, going back again to 2Q of 2021. Revenue, so that's top line. That's just slightly north of 2%. That's 2.6%. Again, that's on a downtrend as well. And again, this is what is anticipated for the next 12 months. And really, that's what we're concerned about. We're not concerned about history. We can't change history. What we're really concerned about is what's coming, and then how do we prepare our business for that? This is interesting as well. This comes from the same survey, again, AICPA Economic Outlook Survey. And these are the top 10 challenges trended over time. And if you really just kind of distill this down and summarize this, inflation is still the biggest concern. And we talked about inflation a couple of minutes ago. And that's really the top two boxes. So inflation and the materials, supplies, equipment costs, those two things, that's inflation. And then your next three is the availability and the cost of people, talent, skilled workforce, those sorts of things. The other thing that's really interesting about this chart, if you look at the 2Q 2022 column at the very, very bottom, stagnant or declining markets. That is new as of this quarter. It's not entirely clear exactly what that means, but stagnant, declining markets, not necessarily a good thing. Here is another survey. This is by Deloitte, and Deloitte is one of the big four accounting firms. They are an international firm. They're enormous. And they do a survey of CFOs in particular. So these are finance professionals that are inside of organizations. And I highlighted the text at the top, which really kind of distills this down. So compared to the previous quarter, the percentage of CFOs expressing more optimism for their company's financial prospects fell to 19% from 27%. And here's the key part. This figure is the lowest it has been since the 2Q 2020 survey. And if you remember, we look back at the 2Q numbers, that is that deep recession. Those are the COVID shutdowns, those sorts of things. And it follows up by saying when the COVID-19 pandemic was sweeping across the world. So that's the lowest optimism we've seen since that period of time. If you strip that out, and which is toward of the right third of that chart there at the bottom, if you strip that period out, optimism is as low as it's been since 2012. And 2012 was certainly a weird economic period too, coming out of the Great Recession in 08-09. So CFOs, same type of message as what we saw in the CPA Outlook survey. KPMG, that is another one of the big four accounting firms. This is hot off the press. This was from a couple of days ago, a day or two ago, but they do a survey of CEOs, so chief executive officers. Those are the top of the food chain inside of organizations. It is a survey of 1,325 CEOs globally. 86, and I took the takeaways here on the right. So 86% believe there will be a recession in the next 12 months. That kind of computes with everything that we've already looked at. 58% believe it's going to be mild and short, TBD. 75% have or will have a hiring freeze in the next 6 months. That's interesting because if you remember that chart that we saw from the CPAs, the availability and the cost of staff is, one of the top 3 out of 5 considerations that they listed there. And then 80% have considered or will consider downsizing the workforce. Where we currently sit right now is unemployment at 3.5% inside of the US. A super interesting fact is that for every unemployed person, so people who are currently unemployed, there are 1.9 jobs listed. So there's about 11 million jobs that are out there, published, posted, listed, and there's about 6 million unemployed people. There is plenty of work out there. And what we're seeing here is that CEOs are considering hiring freezes and or layoffs. It's interesting how that dynamic is going to play out. We'll see. All right, one more. So this was actually yesterday, and this was an article in CNBC, and it's from Jamie Dimon. Who is Jamie Dimon? Jamie Dimon is the CEO and has been for quite some time of JP Chase, which is our country's largest bank. The reason why I pay attention to what Jamie Dimon says is because I am a Chase alumni going way back. It's where I learned how to be a good accountant. And he's a sharp dude. I saw him give numerous presentations, both internally and to the public at large. And these comments were taken out of context from a presentation, I believe, that he gave in London earlier this week or late last week. So the key takeaways from this, the alarm bells are inflation. We talked about that. Increasing interest rates, that's going to have a broader impact on the economy. quantitative tightening. Who knows what that's going to lead to? Obviously, there's uncertainty in the world around the war with Ukraine and Russia. But here's the biggest thing. So JP Morgan is bracing ourselves, and we're going to be very conservative with our balance sheet. That is a direct quote. And what you can read that as is fewer loans going out. And I'm going to touch on that here in a couple of minutes, but put that in the parking lot and just hold on tight to that thought here in a couple of minutes. All right. Other economic data, Federal Reserve Beige Book. And what is the Beige Book? Well, the Beige Book is a quarterly book. It's beige, which is why it's called the Beige Book, or at least it was when it was in physical format, that the US Federal Reserve puts together. And basically it's a survey of all of the Federal Reserve districts. And there's a whole bunch of districts throughout the country. You've got San Francisco, Dallas, Philadelphia, Richmond, Atlanta. I mean, they're all over the place, and they survey those various districts and they see what they're saying. So this is a screenshot that comes directly from the summary. And what this says under overall economic activity is basically the outlook for future economic growth remain generally weak, and the demand over the next 6 to 12 months looks to be weak as well. And therefore, talking about prices, read inflation. Most contacts expected price pressures to persist through at least the end of the year. So this is, at this point, the inflation isn't necessarily transitory. It's kind of here, and they're expecting it to persist through at least the end of the year. The other thing that's interesting here, I didn't highlight it, but it's interesting nonetheless. The labor markets, if you kind of go down to the last sentence there under labor markets, but employers plan to provide end of year pay raises to their workers, but expectations for the pace of wage growth varied across industries and districts. Basically what that means is that pay is all over the map. That is certainly what we're seeing with our client base for sure. It depends on what you're doing as far as remote versus in-house and where you are geographically and those sorts of things. But what we're seeing, it's just the wild, wild west as far as labor markets right now. So economic indicators for agencies specifically, what we've talked about over the last couple of minutes are really broad economic indicators and economic data. This is really specific to agencies. And the source for this is IBISWorld. IBISWorld is an organization that does industry research, and they put together these very comprehensive research reports. And so if we look at the marketing report, the indicators that they list are corporate profits, the number of businesses, total advertising spend, aggregate private investment, business sentiment index, and the number of broadband connections. The broadband connections thing is interesting. The FCC keeps that data. It's generally pretty stale. You can find it on the website. It's kind of hard to access and really make sense of. So take that for what it's worth. Now, this particular list, would I encourage agency owners and agency leaders to sit there and refresh your screen and Google this every single day and look at this data? No, I would not. I'm not terribly crazy about the entire list, but I would certainly take these data points and keep them in the back of your mind and look at them every so often. Basically, what we're trying to get out of this is just a sense of the environment that you are operating in so that you can make more informed decisions about what you're going to do strategically going forward. That's the basic gist of this. But if we look at what this is saying, the corporate profit forecast, so this is what the S&P 500, so not exactly, but basically the top or the largest 500 companies in the US that are publicly traded, what they're going to do from an earnings perspective. And a lot of the agencies that are on this call and will be watching the recording are working with larger brands. So this does apply. But basically what we're looking at is Q4 is going to be okay, certainly not to the levels that we've seen over the last year or so. Q1 of 2023, we're going to be forecasting a dip in profits and then, an increase throughout the rest of the year. And again, this is a forecast and we'll see what comes of that. But I would pay attention to the revisions to these forecasts because they do come out fairly frequently. If there's any indicator that is on that list that I'd be looking at more closely and more frequently, it would be this one, just to see what corporate profits are doing and forecast to do. Number of businesses. So this is the number of business applications. Again, this comes from Fred. And basically what this is the number of EIN applications. So we're using that as a proxy for new businesses. This is really interesting. I mean, yes, we saw an increase through the 2010s, steady increase at that. And then we have a whole bunch of volatility after 2020. That's interesting. I'll talk about that in a second. And then we're kind of in this malaise downtrend type thing if we're looking at the top right. Now, why the 2020 period was interesting, and one of the things that we've been asking our agency clients about and thinking about is that it has become easier and in a lot of cases more appealing for folks who worked in agencies to go out and start their own gigs, freelancing, solopreneur type deal. And one of the things that we've been concerned about is that is a deflationary type of thing, because those people are more likely to compete on price and drive down price. We haven't really seen all of that, but it's one of the things that we've been watching in the last 2 years. And certainly it's something to pay attention to going forward. Advertising spend, and this is using revenue as a proxy. So if advertising marketing dollars are revenue to you as an agency owner or agency leader, they are an expense to your client. So we are using advertising expenditure, or we're using advertising revenue as a proxy for advertising expenditure. That trend has continued to be fairly strong, obviously, as we can see on the chart. Again, how that will continue going forward, we'll see, given the current economic situation. Private investment, this is the net domestic investment for domestic businesses. As you can see, it's been fairly strong, also fairly volatile. And if we look at the top right there, last 2 quarters, not so great. We have seen a little bit of a dip. And again, where that goes from here, good question. The business sentiment index, this is published by IBISWorld. That link is at the bottom. You can Google it. 50 is above 50 is growth, below 50 is shrinkage. We've seen a little bit of a downtick in the last quarter or two, but that seems to be fairly strong, which kind of, if you go back to what those surveys said that I went through at the beginning of this presentation, the optimism for individual organizations and the organization that folks are in has remained fairly strong and fairly steady. It's the overall kind of environment where that sentiment is not nearly as great. Okay, getting into agencies themselves. So this is benchmarking data from ProfitSense. ProfitSense is the largest private company data set aggregator. And this is for agencies across the US with revenue between 1 and 10 million. The data that we're looking at here is sales growth and profit growth, in particular sales growth. What we've seen in the last 12 months, and this is 49 organizations reporting. These are not our clients, but these are just aggregated from financial data that gets reported to ProfitSense. So 27%, 2021 as a whole was 29%, 2020 was 15%. So coming out of that 2020 recession, stronger growth, still positive growth in the last 12 months, but less than what we saw coming out of the 2020 COVID period, we'll call it. And this is fairly consistent with what we have seen with our agency clients. Now, what have we seen with our agency clients at a super high level? Positive year-over-year revenue growth. So 2022 compared to 2021, but certainly less than 2021 versus 2020. Definitely. Credit is more difficult to come by. We've seen that for the last 6-7 months, going back to the March, April time period. Credit has been more difficult to come by. Clients are getting less credit than they asked for, or they're having to go to more organizations to try to obtain credit. It's just gotten a little bit tighter. So when I talked about that Jamie Dimon thing, when he said that their balance sheet is going to be more conservative, that's what that talks to. And that's JP Morgan. I think that we can expect that from other banks and other lending institutions going forward as well. And then number 3, this is a term that we use internally all the time. Weirdness, just general weirdness. Things just seem weird economically and from a business perspective. So deals are taking longer to close. We're seeing that fairly broadly across our clients. And then the labor market, honestly, is just weird. It's hard. It's been hard to recruit. We're also seeing, just wages that are all over the place. It's just been weird. And I'm sure that most of the people on this call have experienced that as well. Okay, so what should you do now? Given all of that information, what should you do? Number 1, and this is in order, the order in which I would do it anyway. Ask your customers how they're doing and do that consistently. Just ask them, how are you doing? How is business? That will give you a sense of what your pipeline is going to look like. So your revenue that you're going to derive from your current customers, but it's also going to give you a sense of what the economy is doing and certainly the sandbox that you're playing in, put it that way. It's also going to give you a sense of the timing for collecting on your receivables from those folks. If they say, business is not so great, then in my mind, what I would be doing is saying, all right, so our collection times are going to be a little bit slower for sure. So that's number 1. Number 2, perform an honest assessment of your pipeline. If your pipeline has been stagnant, if you're seeing if you're assuming that things are going to be 90% probable to close, but they've been out there on a Google sheet or in your CRM for a long period of time, maybe reassess that 90% probability. Maybe it should be 75, maybe it should be 50, but do an honest assessment of your pipeline and what you really expect to close. And again, talk to people, just ask them, how you doing? Start there, see where it goes. Number 3, hoard and or increase access to cash. And if you've got cash, I would certainly hold on to it as best as you can. Increase access to cash. Basically, what that means is line of credit for one, potentially a loan, which is less optimal than a line of credit, but get access to cash. The reason why you need cash is because everything turns into cash. That credit card balance that you have, that turns into cash. Payroll, got to be paid with cash. Everything turns into cash. You need to have cash to operate your business and to stay afloat. Number 4, analyze expenses and see what can be cut. Go into QuickBooks, run a report monthly for expense, and it's called expenses by vendor, and see where you're spending your money and what vendors. And then look at it over the course of each month and say, all right, what are we expecting to come due? What are the things that we don't need? What are the things that we can cut back on? What are the things that are duplicative? Talking about software subscriptions generally, and then go in and make those cuts. Okay. Number 5, forecast cash flow. Do it weekly and forecast at least 90 days out. This is probably the most key part of this entire list. You want to be able to flag problems before they actually become problems. You want to know what you're expecting to come in, and then you want to judge that against prior forecasts. So last week we forecast that we're going to bring in $10,000 worth of work this week. Well, we didn't. Why? And then start asking the questions, go down that rabbit hole. That's going to really, it's going to be super helpful as far as, just planning for the future and making sure that you're making the right decisions ahead of time when before things potentially escalate in the wrong direction. Number 6, consider alternative revenue sources and be creative. We got a whole bunch of creatives on this webinar. Be creative. That's your job. That's what you're good at. What can that mean? Productized services, different verticals. Certainly I like verticals that are tied to hard trends. What's a hard trend? A hard trend is a future fact. Here's an example of a future fact: an aging population. Healthcare costs. Those things are hard trends. So if you're already in those spaces, great. If you can be in those spaces, think about it. But think about hard trends versus soft trends. Soft trends are things that might happen. Hard trends are things that will happen. Here's a great example: tax returns in my business. I know that people are going to have to file a tax return in 6 months plus or minus. That's a hard trend. I know that that's coming. That's going to have to happen whether or not the economy is good, bad, or indifferent. So those are examples. And then number 7, use downtime to upskill your people and upskill your agency. Number 1, your people will appreciate the fact that you are investing in them. And then number 2, it's a good way to innovate in your agency. And when you're at the bottom of a potential recession, if you're continuing to innovate, if you're continuing to get better at what you do, it's going to give you the opportunity as you come out of the recession to be in a much better place and to be way ahead of your competition. So those are the 7 things that I would do now. Additional resources that are available to help you through those things. Number 1, how to recession-proof your marketing agency. There's an ebook that's out on the website, betterwaycpa.com. Go to resources, go to ebooks, guides and more. All this stuff is there. It's all free. So the ebook, if you want to go deeper on what this webinar covered today. Number 2, there's a cash flow 101 webinar. It's all things cash flow. Again, cash is super important, but it'll go through the high level things of this is what cash flow is. Here are the different components to it. Here's how you manage it. It's a couple of years old, but it's still good. It still applies. There's a cash flow forecast template. So if you're not sure how to start forecasting cash flow, there's a template there. There's a video that walks you through how to do it. It's all there. A cash reserve calculator, how much cash you need to have in your business, that's there as well. So when you're kind of thinking, well, how much access, you just told me I need to get access to cash. How much do I actually need? The cash reserve calculator, that's a good place to start. And there's an agency economic indicator dashboard that is coming soon. That'll be out on the website in the same place. So too long, didn't listen. Number 1, the economy is okay now, but not as good as recent history. Number 2, the general consensus is for economic conditions to deteriorate over the next 12 months. And then number 3, now's the time to start planning to weather that storm and be prudent and be intentional. So we are at time. I want to be respectful of everybody's time. I certainly appreciate everybody's time and attention. Sorry, that was a little long-winded. But if you ever need any help, reach out to us, betterwaycpa.com. That's the best place to do it. And hopefully those resources will get you started. So thanks everybody for your time and attention today, and we will see you on a future webinar.